Hello traders, Gary Wagner here. Approximately 1:45 in Honolulu, 7:45 in New York. It is Wednesday, 8th day of September 2021, and this is the daily report for gold and silver. There seems to be a disconnect between events happening in the world and how gold is reacting to them. For the second day in a row, we have seen gold prices decline. Nothing like the carnage we saw yesterday, but a $7 drop nonetheless. On today's report, we will attempt to compare what headlines are out there and how gold is react to it to try to make some sense out of it, if that is possible. Now, for a second day, gold has traded lower. Obviously, not the type of carnage we saw yesterday with a $37 decline, but it did close lower by $7.80, with the December contract currently fixed at $1,790.70. That was really aided by some headwinds, mild headwinds, 0.2%, with dollar strength contributing to the decline. 92.70 is the current print of the dollar index. We are looking at a daily chart in candlestick format of December gold futures. We can clearly see the carnage that was created yesterday with a $37 drop. That, of course, was followed today with another drop of about $7.80. Now, in yesterday's action, it broke below both the 100 in blue, the 200-day moving average in red, and closed just above the 50-day moving average. However, today, gold prices opened below the 50-day moving average, trading lower and closing below the 50-day moving average. Traders, obviously, my belief is that there is a disconnect with the fundamental news and events that are being reported and the reaction to gold. Considering that U.S. equities, for the most part, were meek and not so much under pressure, but hesitant due to the uncertainty as what the Fed will do in terms of tapering, if they'll announce something at the upcoming FOMC meeting. But nonetheless, when you read the articles such as the Beige Book, which came out showing that the economy is definitely weakened due to the Delta variant, the ECB policy being reworked to let inflation run hot as we are here in the United States, it all adds up to a formula that should at least be neutral for gold rather than bearish. Nonetheless, it seems as though traders are focusing upon what the Fed will do during the next FOMC meeting and if they will begin to taper, and reacting to it very, very cautiously. So traders, we remain cautiously, extremely cautiously optimistic under the belief that we should see gold rise in reaction to the fundamental events occurring worldwide. For that reason, we will maintain our current long position as well as our stop, but we will draw a line in the sand, so to speak, at around 1780. That matches up with a couple of lows that came into the market here and here. We are trading overseas roughly at 1792 currently, but we want to make sure that it doesn't drift much lower and we begin to see a series of higher highs, higher lows, as well as higher closes. Silver also lost, giving up 1.61% and is currently fixed at $23.98. As we have seen in gold, silver has also sustained 2 consecutive days of drawdowns. We are still trading below the close in New York today. We have a stop at 22.80, but like we've put a line in the sand in gold, my sense for silver is we want to see it hold the 78% fib retracement, 23.75. I'm rounding it up. If we get a break below there, we will probably look to take our stop to the market. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.